Hey everyone, Marty Missouri here. Good morning. Friday, September 6, 2019. I'll look at two screens. I'll give you a little commentary on the jobs number. That's why I'm a little later this morning. I want to just kind of give you a rundown of what I saw underneath those numbers. Okay, so the daily S&P 500 futures chart on your screen. So we have absolutely, with force and with momentum, broken out of that range that we were stuck in for about a month. And as I keep repeating, remember originally I was pretty certain that we were going to end up coming below that. Now, we could come back, test it, fail, and get back into that range. I've seen that happen a zillion times as well. But right now, we have to conclude that this is meaningful. We definitely cleared out a load of shorts up in here, no doubt about it. Um, is there more short covering to happen? Are we going to get another big boost today if Fed Chairman Powell says something real constructive for markets at 9:30 West Coast time? Well, that remains to be seen. But I will say this, in terms of short interest, and it isn't actually that high overall. I mean, there's plenty, but not the kind of short interest there is, usually at market bottoms. Typically at market tops, you have less short interest. So I really don't know how much there is up in here, and you could get ultimately with yesterday's huge move a clearing out of the lion's share of that short interest. And then what you have, or you just have, now legitimate buying, bulls coming in, pushing the market up higher. And then you have a situation where if we do have, ultimately the makings for more of a correction, which, believe it or not, remains my base case for a lot of reasons. If that does come to pass, right now what we're doing is we're trapping, a lot of bulls up in here. So we have kind of your classic bull trap where we get sucked in. Everybody moves to one side of the boat. Individual investor sentiment got a little more positive this last week. Advisor sentiment is just kind of hanging in there. It's a little too positive for comfort, but it's not in real danger zones. So if we bring more and more people in here and weight up this side of the boat, then you get, just basically just a heaviness or, an external event or a comment from the Fed or a policymaker and so forth related to trade. So just like as everybody was getting pessimistic in here, we had the makings for something big to the upside. But just from a positioning standpoint, this kind of feels like the makings of something, notable on the downside. Regardless, though, in this environment with all the uncertainty out there on a global basis, we are going to get big swings in both directions. Make no mistake. For us to get, decidedly bullish, for us not to want to hedge client portfolios against the potential for a big downturn, we're going to have to see some fundamental macro improvement, and we're going to have to see some improvement in the technicals. And I'm going to have to be convinced that protectionism in the manner that it's been forwarded here of late is going to be off the table, because that is just ultimately, whether it's short term or long term, that just chips away at certainty. It chips away at confidence. It chips away, frankly, at profit margins if companies are having to disrupt, where they have found the most profitable places to do business. And you get profit margins peaking and beginning to contract in an uncertain market, then you've got a pretty messy situation on your hands. So lots going on out there. Right now, it is still, in my view, pretty much the consumer that's holding things up. Consumer rolls over, and we have big, big problems below. So risk reward is just in question, no doubt about it at this point. So we're going to continue to act accordingly as we see the world within client portfolios. Just to run through the jobs numbers, 130,000, which was a disappointment relative to economists' expectations. Notably low number because 25,000 of those were census workers. Of course, those are temporary. In terms of private sector hiring, it was 96,000. That's not good. It was expected to be 150,000. So again, we're talking government jobs largely. June and July was revised lower by 20,000. The unemployment rate stayed at 3.7. Average earnings actually ticked up to 3.2% year over year, so that's positive. And average work week, which I said yesterday, something we look for, that actually ticked up. So that to me is bullish. That says good things about the labor market. However, it was the fifth month in a row with lower revisions. So again, we got to look at trends here. That's a negative trend. Um, and the number of multiple job holders, so people who hold more than one job, that was up 6% versus last year. So again, those are signs of maybe some stress in the labor markets or some stress within the lives of consumers. Um, just the private payrolls themselves, I said it was 96,000. Well, the 12-month average is 165, the 3-month average is 130, and now we're at 96. So again, there's definitely it was a decent enough number. Let me put it that way. Nothing that screams recession. Labor market participation rate actually went up. That's a very good sign. So I would say it's mixed. The bears are going to couch it negative. The bulls are going to couch it positive. I would say it's just mixed, and it is consistent with some of the things that I'm seeing. I mean, yesterday we had a good ISM services report, very good, in fact, 56, which really offset the surprisingly weak recessionary manufacturing survey from a couple of days before. So the composite is okay. But inside that services sector print, you have the subcomponents, and the employment subcomponent looks like it's rolling over. That was down noticeably. So these are surveys right now that could affect next month's jobs number. So all in all, though, it was a pretty good week for economic data, X the manufacturing survey. So the surprise index for the US, I think, is actually going to turn in the neighborhood of yellow in terms of our screen, which means it will no longer subtract a point, at least as it relates to the US from our index. But there's a lot of other things going on under the surface. So basically, folks, as I've been kind of intimating here, we're nearing an inflection point. If the trade war continues and we're having the same conversations about trade a year from now that we're having today, I think we will be in a recession. I feel very strongly about that. And if we are in a recession, under the surface risk in the corporate debt market, and maybe I'll show you a little of those statistics in the weekly message today, make for a very ugly bear market in stocks. So the risk is heightened for a recession. If we get one, the stressors under the surface make it a potentially really bad one. And so everything right now screams hedge those portfolios, protect against the downside until we get some resolution to some of these things. And they very well could resolve higher. So this is not, me betting for sure that the market's going down. This is me or us seeing a substantial amount of risk on top and then a huge amount of risk underneath, and not having the stomach to take clients through what could end up being another 2008 sooner than later. Ultimately, we are going to have to deal with the next bear market, the next recession, and hopefully we will continue to see the risks heightened and take appropriate measures to protect clients against something along the lines of 2008 and what most investors went through back then. Okay, so I apologize. This ended up being longer than I expected. So anyway, so here we have this really nice run in stocks there and even steepening right here. By the way, this is unsustainable, so we will either move sideways, we'll break down below. You can see for whatever reason the big jump in futures this morning is giving up quite a bit of ground right in here. But the day's early. We're waiting for Fed Chairman Powell to speak. Highly probable that the market's going to move notably in one direction or the other, or both, quite frankly. I've seen it jump around on every word when the Fed chairman speaks. Right now, I think another 25 basis point cut is in the cards. Again, the data this week has been okay. There is no justification based on how the Fed thinks and what they're saying for a 50 basis point or a 0.5% cut. The market would love that. If the market starts wanting it too bad, a 25 basis point cut is going to send the stock market lower. A 50 basis point cut, in this environment with the data just okay, that's probably going to be hugely bullish for stocks, I would bet. Sum it all up, and what do you have? You just have a lot of volatility going forward. Okay, so I'm just going to jump on the hourly chart, spend a minute, and let you get on with your day. Okay, so again, broke out of this range right here. I did say it's often you come back, get a back test. You can see looks like futures are trading off here now. Who knows? Maybe certainly on a Fed disappointment, we would easily come down and test this level in here, maybe even come back into it if the Fed really disappoints in terms of Powell's speech today. But we're hugging this 2970, 2975 line up in here. Again, we jumped up here yesterday, did some pull-ups, and then sprung back up here to about 29, a little over 2975, 2980. So we're right now we're on top of the bar, coming down, looking to do some pull-ups and up in here. So we'll see how the market reacts to that. Remember yesterday we looked down here and I showed you some real short-term divergences. Said I would wait if I were a short-term trader for that to resolve itself if I wanted to be bullish, and that was this little dip right in here against this move in here, and we actually never did get the resolution higher. So again, if I woke up in the morning and missed the bounce in futures, if I wanted to go long yesterday, I never would have using these indicators because it never did allow me to do anything. And quite frankly, I think the S&P closed maybe 4 points above this level right here. Remember, we opened with a big gap and then had pretty much nothing. Now we've jumped up to this area, and quite frankly, now we've got a bigger bearish divergence, which is actually being reflected now. The S&P is now negative on the morning, and that's being reflected in here. So if anything, now we break through down below this level, you would go short if you were a short-term trader. Really, right now, I wouldn't pay too much attention to anything until Fed Chairman Powell gives his speech at 9:30. That's going to be telling, and that's going to break us out of this range, I suspect. Longer term, though, you look back here, and we pretty much just have continued, if you will, continued negative divergences, even on the hourly chart. Not huge, but definitely something that would call into question, this rally up in here. These could absolutely resolve higher, and you'd wait for that to happen, then you jump in and maybe ride this thing a little higher if you're a trader. But again, we're not short-term traders here. Maybe I'm getting too much off on that track, but I do think it is telling if you want to get a feel for what's going on under the surface, because a lot of times it's not about economics, it's not about news, it's about the folks who trade trade shares on a technical basis, day in and day out. So I said that would be my last chart. I just decided I'd come back to this one. Let me just show you the MACD and I'll let you go. So speaking of those negative divergences, and remember what I said yesterday about the fractal nature of the market. So here we have this move up here into all-time highs. This says absolutely not. This right here says this is not to be believed. We go back, this is what you'd call a divergent high. You've got a negative divergence and you've got a new high. When you find these things back in here, and leading up to this, we got this big rollover in here. But notice here, we had the market down, right? And here we had a move up. That is a positive divergence. And here we had a market that continued to sustainably, hold its own until we had this new peak, right? And then we had this negative divergence. And then, and then we had that correction in May. And we have not been able to come back up. So that says you should tread very softly up in here if you're a technician and you use these particular indicators for momentum. Even though this is positive, this is a short-term buy signal. I use these things more for the trends, and I look for positive and negative divergences. This we're seeing on the daily, the weekly, and the monthly, and this is what I showed you yesterday. On a longer term basis, there's just not a lot, technically speaking, to feel good about up in here. And that's why I keep saying there's a lot of technical damage that needs to be undone, along with the fundamental damage, and that's, vis-a-vis our index and so forth, before we can, feel good about getting back into this market in any kind of a aggressive fashion, for lack of a better term. So folks, I will leave it there. That's it in a much bigger nutshell than I expected to give you this morning. Thanks for your patience, and I'll be back with much more. Have a great day and have a great weekend. Bye-bye.